Hey everyone, this is Kirk here again at optionalpha.com, where we show you guys how to make smarter trades. And today we're going to cover all of the trades that we made for Wednesday, August 6th. And it was a pretty busy day again, two opening and two closing trades. And the first trade I want to go over tonight is Walgreens. Now, as always, if you guys have any comments or questions about the trades we make or why we did something or didn't do something else, please ask them right below here in the comment section. I'll get back to all of those tonight or tomorrow before the open. So the first one I want to go over is Walgreens, obviously because Walgreens had a huge drop in its stock price today. Company basically announced that it wasn't moving its offices out of the US or whatever the case is. Needless to say, the stock made a pretty ridiculous move, one that implied volatility kind of sort of predicted. The fact that implied volatility was so very high, but the move that it made was pretty astronomical and really nothing that we or anybody else could have predicted. So we did end up, after everything was said and done, and I'll kind of walk through my thought process on this in a second here, but after everything was said and done, we ended up closing back out of our very wide original strangle in Walgreens, which was the 80 call and the 65 put. So the 80 is related to that call and the 65 is related to this put. So we had the 80-65 strangle on Walgreens, had originally entered it for about $1.27 credit and bought it back today for a $5.50 debit. Took a nice loss of $4.23. Obviously not what we want to have happen, but this is why strangles are very profitable when they work and not so profitable when they don't, unfortunately. So here's a look at where Walgreens is. You can see just how big of a move the stock made today. It closed yesterday around 69, opened up about $10 lower here today, and just made a pretty huge move lower. Again, nothing related to earnings or any dividends or anything like that, just purely company news. And this is the risk that we all take by doing this. But we just want to make sure, as always, that we're trading these things very small. In our case, it was just, a very small one lot that we traded with Walgreens. Now, the reason that I didn't get or adjust this trade is because there was really nothing to adjust. So I know a lot of people sent me comments and said, hey, Kirk, why not roll down the call side from 80 to something closer? And I would do that, but if I rolled it down at the time to something around 60 or 62.5, and by rolling it down, taking a profit on the call side, so taking a profit on this side, and then re-entering a new order closer to the market for the same expiration month, I really wouldn't take in a massive credit, maybe $16, $45, something like that. That's what it was trading at when we actually made this trade at the end of the day or at the beginning of the day. So by actually making that adjustment, even though I took in a credit, which I always like to do, I always like to take in a credit on adjustments and rolls, I really wouldn't have gained anything out of this, right? I would have taken a small credit. It still would have been a pretty big loss, and we still would have had a lot of downside exposure. So if Walgreens kept falling, it really would have done nothing except give us a small bump in our credit to do this for like $25 to $80. So not a big adjustment as far as I'm concerned, and definitely one that you just have to unfortunately take off the table because we've made other trades that have worked out really well. Groupon was a very good trade for us today. Other trades have worked out really well. This is one of those ones where it just made a move that was so erratic, something that you just never see, and with so little time left, you really can't even close this thing out or make adjustments for August. Now, the second thing I did look at was, again, rolling it to next month. So if we didn't trade anything in August, why not roll the entire spread out to out to September? And the problem with doing that is if you roll it out to September, you take a massive hit on this side as far as the credit for the 80s. And again, you really don't get a lot of premium for your options when you roll down the call side. So, the put side, you take a massive hit rolling this one out to the 65s on the put side. On the top side, for the 80s, you don't get a lot of credit, so you still get about $80. Maybe if you're really aggressive, you get $164, $165. Again, not anything that's really going to make me feel warm and fuzzy about reestablishing this position for another 44 days just to see Walgreens trade all over the map. So at this point, we're going to take the loss and move on to other trades. That's just what we have to do with this trade, but I kind of wanted to work through my thought process, and really it just boils down to the fact that there just isn't enough credit left even if we roll this trade out to next month. And I guess that really boils down to the fact that implied volatility has gone from almost 90th percentile down to the 44th percentile in a day. So even though the stock made a hellacious move lower, implied volatility has dropped dramatically, and that means that all the option premiums have condensed around around this stock. All right, so the other trade that we did close out today was our Groupon earnings trade. Again, I know yesterday we got this trade filled about 2 minutes before the close of the day, so the alert didn't get out to some people, didn't hit your text messages or your phones until after the market closed. But again, I always want to make sure that you guys see all of our trades, good, bad, or indifferent, whatever the case is. And with the Groupon trade, Groupon did open up lower, which we talked about last night in the video. We had the weekly options, which were the most front options, which only have a couple days to expiration, so therefore decay very, very quickly. And right at the open today, we closed out of our iron condor. We bought back our 7-8 call spread and our 6-5 put spread. The price that we paid for all of that, buying it back, was 26 cents. So we made a $28 profit on each of those 3 iron condors that we bought back. So nice little trade in Groupon, considering that we really only had the trade for, I think, a total of maybe 8 or 9 minutes, counting yesterday and today. And you can see that the stock did open up lower, rallied throughout the day, which really would have helped in this position, practically would have expired worthless, but you never know what's going to happen after the market open. Last year, when Groupon, or last earnings cycle, when Groupon opened up lower, it continued to fall all throughout the day. So that was my expectation, is that if this thing opens lower, that it might just continue to fall, and I don't want it to run even further out of the money with our spreads and start to actually lose money. So we close this thing out right at the open, take what profit that the market gives you, and just move on to the next trade. All right, we did have 2 new opening trades for today, and they're both butterflies, but they're a little bit different. One is a broken wing butterfly, and the other is actually a regular butterfly. Something that we haven't traded very often, but I just kind of like the setup in EWI for the regular butterfly. So let's talk about EFA for the first one. So with this broken wing butterfly, you'll notice 2 things. One, that we bought this, and so there's, on our trade alert signal, it says bought 3, so we did 3 complete butterflies. However, down here at the end, it shows a -8 and a credit. Now, this does still mean that we bought a butterfly spread, but because we took this thing and made a broken wing out of one side, we actually got paid a credit for entering this trade. And so we actually took in money to enter this trade. We did not pay money to enter this trade. So just to really clear that up. But as always, what we did with this butterfly is we went ahead and bought the 66 put options, sold twice as many of the 65 options, and then skipped over 64. So you notice there's $1 difference, and then we skip over 64 and we go all the way down to the 63s, and we bought those 63 put options. By buying these 63 options, which are dramatically less in price than the 64 options, that gives us an overall credit. That's what really helps turn this thing into a broken wing butterfly and gives us a credit. So let's go here to the chart of EFA, just so you guys can see the setup. Very high implied volatility, which is really good. And you'll notice that we did the put butterfly spread because we actually want the market to actually rally back up higher. So that's what we want to do. So we set up our butterfly spread down here around 65, gives us a little bit of margin of error below the market to be right. So EFA can still trade a little bit lower, but ideally we want this thing to bounce back. And that's what we're playing. We're playing here market reversion, that sometime between now and expiration that this thing is going to bounce back. If we actually go to the Analyze tab here of EFA, and you guys can see exactly where our spread is, you'll notice that we have 3 of the 63 puts that were long. We have 6 of the 65 puts, so twice as many of the 65 puts that were short. And then we skipped, and then we have the 3 that were long, the 66. Again, notice that we skipped completely over the 64s and went right to the 63s. So that creates, on the left side of this payoff diagram, this broken wing, or the kind of this longer wing of the butterfly. Now our profit zone is anywhere between a little under 64 and up. So by taking in a credit, that guarantees that if EFA does continue to just rally and make a monster reversal higher, that we don't actually lose any money to the top side. So our major risk is to the bottom side, but we are playing this directional. So we do want EFA to close higher. If it does trade anywhere between about 66 and 64, we have an opportunity to make a little bit more money. So that's obviously what we want to happen. Going back to the chart, we'd ideally like to see EFA trade somewhere between 66 and 64. So it still gives us a very, very big profit window to make some serious money Above 66, we still keep our 8-cent credit. Below 64 is when we start losing money. So you can see we've given ourselves a pretty good healthy margin of error for this thing to continue lower and still make money all the way down to 64. All right, so this is actually a little bit different than EWI. So EWI, you'll notice, and this is ironic that we did both of these trades on the same day, but EWI is a very even butterfly. So you'll notice we did the 15, 16, 17, all dollar-wide strikes. Very similar to the setup as EFA. So we bought the 15 strike calls, sold twice as many of the 16 strike calls, did not skip a strike, but then bought the 17 strike calls. All in all, because we did not skip a strike, this cost us a little bit more money and we paid 32 or 37 cents in debit. Now in this case for EWI, and let me just actually go to the profit loss diagram first. With EWI, we actually have a very even butterfly, so no broken wing on this side, and want the market to close just between where our break-even prices are. So call it around 15 and a quarter and 16.75 or so is where we want the market to trade. A very narrow window, but if that happens, then we actually stand to make a pretty good chunk of change. And on either side of that, we just lose our debit, which is the money that we outlaid to get into the spread, 37 cents on either end. But you'll notice a very even spread. And the reason that I decided to do this, just to mix it up here a little bit with our strategies, with EWI, I'm giving it a little bit more upside room, just like with EFA. I think that at some point we're going to see a little bit of a rally here. So I like the idea of seeing this thing kind of rally between, again, call it 15 and some change, and then up to 16.75 or so. So giving this a nice little profit window up here to kind of rally, retrace this move, I think it's definitely a possibility. And if implied volatility drops during this period at any time, that's obviously going to help us make a very, very nice profit quickly just on the move down in implied volatility. So with this trade and this butterfly, since our short strike is at 16, that is ideally where we'd want the stock to end up by expiration, somewhere around 16. It gives us the ultimate profit potential in this thing. That never usually happens, but if it does, that's exactly where we want the stock to be pinned. So somewhere around 16 would be ideal. A little bit of a rally here, but not too much for EWI. So as always, I hope you guys really enjoy these videos. If you have any comments or questions about the trades we made today, please ask them right below here in the comments section. Share, like this video online on Facebook, YouTube, Twitter. Help us spread the word of what we're trying to do here. Again, you can see that we show you guys everything, good, bad, or indifferent. I'm an open book as far as our trades. Trades that we enter that are great, we'll show you. Trades that we enter that didn't work out so great, we'll show you, because this is what it is. This is real trading and it's real money at stake. As always, hope you guys enjoy and happy trading.